January is where many business owners make a quiet mistake. They assume last year is done because the calendar changed. But in reality, the most important financial work for last year happens now. What you do or don't do in January directly affects your taxes, your cash flow, and how confident you feel about your business all year. Why January matters? Right now, businesses are closing their 2025 books and preparing for tax season. During the year, most owners are focused on serving clients, running jobs, managing employees, and keeping things moving. Bookkeeping often becomes something that kept up with but not deeply reviewed. January is the pause. It's the moment to step back and make sure last year's numbers actually reflect what happened in your business. This is especially important for contractors and service businesses where income and expenses don't always happen cleanly month to month. So, what closing the books really means? Closing the year properly is not just about categorizing transactions. It's about alignment. You are making sure three things line up: what your business earned, what your business spent, and what the IRS will eventually review. January is when this alignment should happen. And here is the checklist what that actually looks like. Number one, bank and credit card reconciliations. Every bank and credit card account should be fully reconciled through December 31st. This ensures no missing income, no duplicate expenses, no transactions sitting uncategorized. If accounts are not reconciled, the numbers cannot be trusted. Number two would be income review. Make sure income matches reality. Ask, was all income recorded in the correct year? Are deposits properly labeled as income versus owner contributions or transfers? Are any large deposit unclear or unsupported? This is critical for tax reporting. Number three, expense classification. Expenses should be reviewed carefully, not rushed. So you look for personal expense mixed into business accounts, large miscellaneous or own categorized balances. Expenses that may need to be split or reclassified. Clean expenses is equal to clean deductions. Number four, payroll and contractor review. Payroll records should match what hit the books. So confirm payroll expenses matches payroll reports, payroll taxes are recorded correctly, and contractor payments are clearly tracked. This also prepares you for W-2s and 1099s. Number five, owner pay and distributions. Owner transactions are one of the most common problem areas. So review owner's draws versus payroll, personal expenses paid by the businesses, any large or unusual owner transactions. Misleading these can distort profit and cause tax issues. Number six, assets and large purchases review. Review any big purchases made during the year. Should this be expensed or depreciated? Was it recorded consistently? Does it need supporting documents? This directly affects taxable income. When this checklist is skipped or rushed, issues don't disappear. They show up later as financial reports that don't make sense, higher tax bill than expected, confusion during tax preparation, or decision being made on incomplete information. The IRS does not look at effort, they look at numbers. January is your opportunity to make sure those numbers tell a clear, accurate story. The goal of closing your books is not perfection, the goal is clarity. When the books are closed properly, you know what last year truly produced, you understand where cash actually went, and tax planning becomes proactive instead of reactive. This is why some businesses feel profitable but still feel financially stressed. It's rarely because they are failing, it's usually because the financial picture was never fully reviewed. And January is the moment to fix that. January quietly sets the tone for the entire year. When last year is closed with care, this year becomes easier to manage, not harder.